If you know something that will drive a company's earnings higher, you know something that will drive a company's stock higher, sooner or later. But you can't just guess at it. You have to have some reasons, such as costs are coming down, or a new product's going to be a big hit. Research is developing a company's story, an idea of why earnings should go up or down. It doesn't mean sitting in the library for hours, reading SEC filings, or fiddling with a calculator.
Research is exciting. It's very little math. When I owned Chrysler, it was the biggest position in my fund. When I was at a movie theater, at a sports event, I'd run into somebody driving a minivan. I'd ask them, what do you think of the minivan? Would you buy another one? What do you like about it? Some would say, well, it's a little underpowered. They only have a 4-cylinder engine. I knew they were already working on a 6-cylinder engine. So this is research.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job. I owned Dunkin' Donuts for 12 years. I think I might have talked to them once every year. The story didn't change a lot. You don't have to worry about low-cost imports coming from Korea. You don't have to worry about the economy. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they had just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu, they kept their costs low, they added breakfast, they went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. Lots of good companies had nothing to do with wars, nothing to do with banking. They all went down in 1990. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. This is a company that's had 35 years of double-digit earnings growth every single quarter. We've had changes in the Supreme Court, we've had changes in presidents, we've had recessions, we've had wars. All of those things had no effect on automatic data processing. We had the stock market go up and down, so every time the market went down, it gave you a chance to buy it. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam.
Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount.